First, let's look at why companies invest. They can invest in debt securities, which would be bonds, or they can invest in equity securities, which would be stock investments. Why would you invest as a person? For one, you would invest to earn money. If you could only lose money by investing, no one would do it. We can earn money with our stock investments by receiving dividends and hopefully selling stock at a greater value than you had purchased it for. You can earn money through bonds by receiving semi-annual interest. Some companies are set up to produce income from investments. This is especially true for entities such as mutual funds and pension funds. Companies also invest for strategic reasons. Some examples include investments in competitors, suppliers, or customers. This can help companies earn more favorable pricing, take out the competition, and enter into new markets. This slide highlights the differences between debt and equity securities, which remember means bond and stock investments. Debt securities reflect a creditor relation, while equity securities reflect an owner relation. When purchasing debt securities, you're investing in the debt of that company. You are essentially loaning them money. With an equity investment, you are becoming an owner of that company. You can sell those shares on the open market, but there is no guarantee that the stock will increase in value or that the company will repurchase the stock from you in the future. You can purchase bonds from companies, governments, and even individual people. Like I said, you're essentially loaning out money. There are many types of bonds, such as municipal and federal bonds. You may have even received bonds at some point in your life. When I was younger, people were always receiving treasury bonds for their birthdays, communions, and other events like that. Stock can only be purchased from companies. There is no government stock, and an individual cannot issue stock for themselves. Debt securities are not only bonds, but notes and CDs as well. CDs stand for certificates of deposit, which you usually purchase from banks. When I was younger, CDs had very attractive interest rates, and many people invested in these. Nowadays, not so much. I do have some elderly clients who still invest in CDs, but the younger generation invests mostly in stocks. When purchasing equity securities, you would be purchasing shares of stock, since this is the only type of equity security. The last slide for this topic is on the short or long-term designation for securities. Short-term investments would be classified as current assets on the balance sheet. Short-term investments must meet these two requirements, both of these requirements, in order to be considered short-term. They must be intended to be converted into cash within 1 year or the operating cycle, whichever is longer, and they must be readily convertible to cash. So you have to have the intention of selling these within a year and needs to be easily able to turn into cash. These investments usually mature between 3 and 12 months. If maturing in under 3 months, then those securities are usually listed as cash equivalents on the balance sheet and they're not considered short-term investments. On the other hand, long-term investments are not readily convertible to cash and not intended to be converted to cash in the short term. This can include funds designated for special purpose funds or investments in land or other assets not used in operations. We really won't be discussing cash equivalents in this chapter, so you can just keep in mind that short-term investments are ones you want to sell in under a year, and long-term investments are the ones you want to sell in over a year.